You see a massive green uptrend approaching a resistance level. You immediately press sell, anticipating a reversal. But the trend ignores you, violently spikes higher, destroys your stop loss, and then finally reverses. You were right about the direction, but mathematically wrong about the timing. You tried to catch a falling knife. Today, I will teach you the exact science of momentum decay, how to visually spot a trend exhausting and dying before the reversal actually happens. To truly master the art of catching market reversals, we must fundamentally change how we look at a price chart. You must stop viewing candlesticks as a collection of random shapes and colors, and start looking at the global financial market through the strict, undeniable laws of physics. The Forex market is an ecosystem processing over $7 trillion a day. It possesses immense financial mass, and therefore, it absolutely must obey the physical law of inertia. Imagine you are watching a massive, heavily loaded freight train traveling at 100 miles per hour down the train tracks. If the engineer decides to stop the train and reverse its direction, they cannot simply pull a lever and instantly travel backward in a single second. If they did, the train would derail and be annihilated. The sheer physical mass of the train makes an instantaneous reversal completely impossible. The engineer must first cut the engine power. Then they must gradually apply the brakes. The train will continue moving forward for a mile, steadily decelerating from 100 to 60 to 20 to 5 until it eventually comes to a complete dead stop. Only then can it successfully engage the reverse gears. The financial market moves in exactly the same way. When an explosive macroeconomic uptrend approaches a major institutional supply zone, it does not just hit a razor-thin resistance line and instantly bounce like a rubber ball. The institutional algorithms that initiated the massive upward push need time to offload their heavy positions. As they stop buying and start systematically distributing their long positions to retail traders, the underlying kinetic energy of the trend begins to evaporate. The market continues to slowly push higher due to residual inertia, but the speed, the aggression, and the underlying volume dramatically decrease. This critical deceleration phase is called momentum decay. It is the absolute most important phase of the market cycle, yet 99% of retail traders are completely blind to it. They see the price moving up, suffer from the fear of missing out, and blindly hit the buy button, stepping right in front of a train that has already applied the brakes. Or worse, they hit sell the exact second the price touches a line, getting run over by the remaining forward inertia. As a professional trader, your job is to observe the price action objectively and mathematically measure this deceleration. You want visual proof that the buyers are exhausted, their capital is depleted, and the train has officially lost its forward momentum. When you successfully identify momentum decay and wait for the perfect reversal setup, your execution speed becomes your absolute most valuable asset. During major market turns, volatility spikes massively as algorithmic bots battle for liquidity. If you use a low-quality broker, your platform will freeze, spreads will widen exponentially, and you will suffer devastating slippage, completely ruining your precise entry. That is exactly why I exclusively trade with and recommend XM Broker. XM provides globally regulated Tier 1 institutional liquidity. This ensures that when the market reverses and you click sell, your order goes through instantly with absolutely zero requotes. Click the link in the description to open an XM account and secure your institutional edge today. The absolute first and most reliable visual signature of momentum decay is found in the physical size of the candlestick bodies. To read momentum correctly, you must remember that the solid body of a candlestick, the colored area between the open and the close, represents committed institutional mass. It shows the exact distance that buyers or sellers were willing to conquer and mathematically hold until the session closed. When a bullish trend is healthy and highly aggressive, you will see a sequence of massive, thick, full-bodied green candlesticks closing near their absolute highs. This proves that institutional buyers are relentlessly sweeping the order book, injecting massive amounts of capital, and effortlessly consuming all available sell-side liquidity. But as the price travels higher and enters a premium supply zone, you must pay extreme attention to the sequence of the bodies. You are hunting for a highly specific structural pattern, sequential shrinkage. Let us look closely at an exhausted trend. The first candlestick in your sequence closes with a massive body that spans 50 pips. The buyers are in complete control. The next candlestick also closes green, making a new higher high, but the body is only 25 pips tall. The third candlestick closes green, but the body is only 10 pips tall. The fourth candlestick is a microscopic doji, where the open and the close are practically the exact same price. What is the physics of this chart telling you? The trend is technically still moving upward. It is consistently making higher highs. This structural illusion tricks retail traders into believing the trend is perfectly healthy. But the volume tells a terrifying story. The financial effort required to move the price is massively failing. The buyers are rapidly losing their kinetic energy. The initial 50-pip candle required massive, aggressive capital. The subsequent 10-pip candle shows that the buyers are desperately throwing their remaining money at the market, but they are hitting a dense, invisible wall of institutional sell limit orders. Their buying power is being completely absorbed. This sequential shrinking of bodies is your ultimate early warning system. It is the visual manifestation of the brakes being applied. When an amateur trader looks at this chart, they just see 4 green candles in a row and blindly buy at the exact top. When you look at this chart, you see a dying trend gasping for its final breath. You know that a massive reversal is imminent because the institutional demand has mathematically evaporated. As the candlestick bodies begin to rapidly shrink, a secondary physical phenomenon must occur to confirm true momentum decay: Wick expansion. While solid bodies represent committed mass, wicks represent elasticity and violent rejection. They are the physical, visual scars of an intraday battle that the buyers aggressively fought and completely lost. If a trend is cleanly breaking through weak resistance, it will do so with solid bodies and very few wicks. The path of least resistance is up. But when a trend is entering a state of terminal decay, the market structure fundamentally changes. The retail buyers, refusing to give up and fueled by pure greed, make desperate, volatile spikes upward, trying to force the price into new highs. However, because they are entering a heavy institutional supply zone, these aggressive spikes upward are immediately met with an impenetrable wall of algorithmic selling pressure. The smart money sellers instantly absorb all the retail buy orders and violently force the price back down to the candle's open before the session actually closes. Visually, this leaves a devastatingly long upper wick, pointing directly in the direction of the trend. When you analyze the final stages of an exhausting uptrend, you will often see a terrifying combination. The candlestick bodies are getting progressively smaller, while the upper wicks are getting progressively longer. This is the ultimate signature of order book friction. The long wicks prove mathematically that the price is physically exploring higher, premium territories, but absolutely zero value is being accepted there. Every single attempt to push higher is immediately slapped down with extreme prejudice by the institutions. The buyers are completely trapped at the upper extremes. When you see a sequence of 2, 3, or 4 consecutive candles with tiny bodies and massive top wicks piercing into a key resistance level, the forward momentum is completely dead. The elastic band has been stretched to its absolute maximum limit, and the structural tension is heavily loaded, ready to violently snap in the opposite direction. You do not need to memorize hundreds of arbitrary candlestick names to be profitable. You simply need to recognize the physical evidence of exhaustion: shrinking mass paired with expanding elasticity. Let us zoom out from the microscopic view of individual candlesticks and look at the broader macro structure of the trend. The third law of momentum decay is found in the geometric angle of attack. A healthy institutional trend attacks the market at a very sharp, aggressive geometric angle. When a major trend originates, the initial burst of institutional order flow is highly explosive. The trend might move upward at a very steep, aggressive 80-degree angle. The pullbacks are incredibly shallow, and the impulsive pushes are massive and dominant. This sharp angle proves that the imbalance between buyers and sellers is extreme. The buyers have total control. However, no financial market can sustain a nearly vertical trajectory indefinitely. It requires far too much capital to maintain that speed. As the trend matures and begins to consume all the available liquidity in the order book, the geometric angle of attack must mathematically change. You will notice the trend starts to physically lean over. The aggressive 80-degree angle drops to a 45-degree angle. The impulsive legs upward become significantly shorter, and the pullbacks become much deeper and more complex. The market is visually struggling to cover new ground. Finally, in the absolute terminal stage of the trend, the angle flattens out entirely to 10 or 15 degrees. The price is still technically printing marginal higher highs and higher lows, which keeps the retail traders trapped in a bullish bias, but it is moving inside a highly compressed, suffocatingly tight channel. If you trace a curved line across the top of this price action, it looks exactly like a dome or a rounding top. This geometric shape is a massive warning sign. The rounded top proves that the buying pressure is losing its dominance, and the sellers are slowly and methodically increasing their pressure, bending the trajectory of the market back down towards the earth. Trading a breakout on a flat, rounded dome is mathematical suicide. You only trade upward breakouts when the trend angle is steep and aggressive. When the angle flattens out into a tight wedge, the trend is actively decaying, and a massive reversal is imminent. Why do these slow, agonizing compression phases happen in the first place? Why doesn't the market just reverse instantly the second it hits a resistance level? The answer lies in the dark art of liquidity engineering. Massive financial institutions and central banks cannot simply execute a billion-dollar short position at the exact top of a trend without a massive amount of retail buyers to sell to. If they dumped all their massive sell orders onto the market at once, the price would crash instantly, resulting in terrible execution prices for the banks themselves. They need to artificially manufacture deep liquidity. When the trend slows down and forms a rising wedge, it creates a brilliant psychological trap for retail traders. Because the market is still slowly grinding higher, printing marginal higher highs, retail momentum indicators might still look bullish. Retail traders see the slow grind and convince themselves that the trend is just consolidating before the next massive leg up. So, they continue to open long positions. More importantly, as the market slowly grinds up inside that wedge, retail traders draw a tight diagonal support trend line underneath the structure. They meticulously trail their stop losses right below that diagonal line, moving them up every single day. Over the course of hours or days, an absolutely massive, highly concentrated pool of automated sell orders builds up directly beneath the wedge. The smart money intentionally engineered this slow decay. They are quietly shorting the market, absorbing the retail buying pressure, and patiently waiting for the stop-loss pool to become massive enough to fill their orders. Once the trap is fully loaded, the institutions pull their remaining buy limit orders. With the floor suddenly removed, the market collapses. The price violently crashes through the diagonal trend line, triggering every single retail stop-loss in a devastating cascading effect. The slow momentum decay was nothing but a calculated harvesting operation designed to use retail capital as fuel. While price action gives us the raw physical evidence on the chart, professional traders also look under the hood to measure the internal engine of the market. This brings us to the concept of momentum divergence. To measure divergence, we use an oscillator, such as the Relative Strength Index, or RSI. But we absolutely do not use it the way retail traders do. We do not care if the RSI is simply overbought, or oversold. We use it strictly to measure the internal velocity and effort of the price pushes. Here is how you spot hidden momentum decay using divergence. You look at the actual candlestick chart, and you see the price push up and create a new higher high. Structurally, the trend looks perfectly fine, but then you look down at your RSI oscillator. Instead of printing a matching higher high, the RSI prints a distinct lower high. This is bearish divergence, and it is a massive exposure of the market's true weakness. What the math is telling you is that yes, the price managed to squeeze out a new high, but the internal volume, speed, and participation behind that push were significantly weaker than the previous push. Imagine a car rolling up a steep hill. The car is still moving upward, and it reaches a new highest point on the road. But if you look at the RPMs on the engine dashboard, they are dropping rapidly. The car is rolling purely on leftover inertia. In a few seconds, gravity will take over, and the car will start rolling backward down the hill. Divergence is the ultimate confirmation that the momentum decay you see in the shrinking candlestick bodies is backed by a genuine, mathematical loss of volume. The engine is dead, and the institutions are simply dragging the price higher one last time to induce retail buyers before crashing the market. When you combine shrinking bodies, expanding wicks, and bearish divergence, the reversal is highly probable. Inside these compression phases, algorithmic order flow frequently prints a highly specific structural fingerprint known as the 3-push pattern, or the 3-drive. This is the ultimate final sequence of momentum decay before a catastrophic collapse. The market approaches a major structural level and initiates the sequence. Push number 1 is strong and aggressive. It creates a new higher high, drawing in the first wave of retail buyers. The market then pulls back slightly. Push number 2 occurs. It breaks the high of push 1, but if you visually measure the geometry, the physical distance traveled is significantly shorter than push 1. The momentum is visibly decelerating. The buyers are struggling. The market pulls back again. Then comes the fatal move. Push number 3. This is the exhaustion climax. Push number 3 is almost always a highly engineered synthetic move. The institutions intentionally orchestrate one final desperate spike upward. It barely breaks the high of push 2, but it is just enough to trigger the breakout buyers and sweep the early sellers' stop losses, resting just above the highs. This third push is entirely fake. It possesses absolutely no underlying volume support from the buyers. As soon as the liquidity is completely swept, the price violently rejects, leaving behind a devastating terminal wick. The sequence is complete. Push 1 was the trend. Push 2 was the deceleration. Push 3 was the terminal trap. When you identify a clear 3-push sequence culminating in a long exhaustion wick exactly inside a higher timeframe supply zone, you are looking at one of the highest probability asymmetrical trade setups in the entire financial ecosystem. The spring is fully loaded, the buyers are trapped, and the massive reversal is mathematically inevitable. Now, we must address the single most important rule of this entire methodology. Momentum decay means absolutely nothing if it occurs in the wrong location. Context is king. If you open a 15-minute chart and spot perfect body compression, long wicks, the 3-push pattern, and RSI divergence, but the price is floating in the absolute middle of a trading range, far away from any major higher time frame resistance, you must ignore it completely. When decay happens in a void, it is not an institutional reversal. It is simply algorithmic noise. It is the market taking a brief, random pause to catch its breath before continuing the trend. Momentum decay only becomes a highly lethal, tradable weapon when it collides with a massive, pre-established institutional wall. Before you even look for decay, you must identify your massive, unmitigated daily supply zones. These are your absolute kill zones. When the price finally touches the bottom edge of your daily zone, you drop to the lower time frames and hunt for the decay. Suddenly, the bodies compress. The long top wicks appear. The RSI diverges. You are witnessing the physics of the market reacting perfectly to a concrete wall. The massive buy-side momentum is literally smashing into a multi-billion-dollar wall of institutional limit orders. The location validates the decay, and the decay validates the location. We have successfully mapped the decay, observed the wicks, and identified the climax. But here is the ultimate rule that saves retail accounts. Deceleration is a warning sign, not an entry trigger. You never step in front of the train while it is still moving forward. A dying trend can grind higher for days, slowly bleeding out early sellers. You must wait for the train to completely stop, engage the reverse gears, and physically prove that it is moving in the opposite direction. We wait for the snap, the structural change of character, commonly known as a ChoCh. On your execution time frame, you identify the absolute last, most recent higher low that the market created right before the terminal climax wick. You draw a horizontal line at that exact swing low. You sit on your hands and do nothing until a massive, aggressive red candlestick violently crashes through that line and closes below it. This structural break is the ultimate, undeniable mathematical proof that the buyers are completely dead and the institutional sellers have forcefully taken control of the order book. Once the change of character prints, the institutions leave behind an unmitigated order block on the 15-minute chart. You calmly wait for a quiet, low-volume pullback directly into that newly formed supply base. You place your sell limit order exactly at the edge of the zone. You place your stop loss just a few pips above the absolute extreme climax wick. Because you waited for the decay to complete and the structure to explicitly shift, your stop loss is incredibly tight, perhaps only 8 or 10 pips. But your take-profit target is the entire origin of the macro trend, which could be 100 pips away. You are risking 1% to make 10%. By patiently reading the physics of momentum decay and demanding structural confirmation, you effortlessly unlock the high-probability sniper entries that professional traders use to build generational wealth. Let us summarize the masterclass. Reversals are not random events. They are the final stage of a highly physical deceleration process. Stop trying to catch falling knives at static resistance lines. Demand visual proof that the institutional momentum is actually dying. Watch for the sequential shrinking of candlestick bodies. Look for the expanding elastic wicks that prove buyers are trapped. Analyze the angle of attack as it compresses into a tight wedge, specifically hunting for the 3-push climax pattern. Confirm the death of the engine with oscillator divergence. And finally, possess the elite psychological discipline to wait for the microscopic change of character before you ever risk a single dollar of your capital. If you stop trading the shapes and start trading the underlying physics of order flow, you will permanently stop being the liquidity and start trading alongside the institutions. If this deep dive transformed your understanding of the market, hit the like button, subscribe to the channel, and ensure you check out XM Broker via the link in the description for flawless, zero requote execution. Master your patience, read the momentum, and I will see you in the next video.